Hi, and welcome back to Channel 11. I'm Ken Shinoda, your host today, May 4th. And we're a little into the month of May, but we're going to do a review of April, which I titled Another One Bites the Dust. And yet another one bites the dust as we look at some of these other regional banks like PacWest looking like they're potentially out of business as well. But First Republic was the big news that happened on a Sunday before the start of the month. So here we go. Through April, the stock's up again, S&P up over 1, now up over 9% on the year through April. We have given back some of these gains. Most of the US indices are down around 2% or so on the month, so giving back a little bit of the gains, especially on the Dow now, barely positive on the year. NASDAQ, the high flyer, mega cap tech, leading the charge in the S&P, and we can see that in the NASDAQ as well. Russell 2000 lagging here, and the rest of the world also doing pretty good thus far through the year. Double-digit returns out of Europe, out of Asia in dollar terms. Here's a breakdown by sector. We looked at this last month. We saw that the winners of last year are the losers of this year. Consumer staples, healthcare, utilities, things like that, energy, and everything that was lagging last year is rip-roaring back. A lot of that technology type stocks up over 20%, 25% on consumer services. Dollar continues to be weak versus the euro and yen. We expect further dollar weakness once the big deficits that we've been accumulating in the US come to the forefront. So one of our longer-term themes at DoubleLine has been non-dollar investments on a go-forward basis. Not saying today is the perfect time for that, but just big theme. But thus far, again, the dollar down a little bit. And commodities being weak. So everything but gold has been pretty weak. Copper, it's up slightly on the year, but I think this is one of the reasons that you've seen goods inflation start to come down. Commodities are not inputs into services inflation. That's a lot of wages. We're going to look at this a little bit later. But again, this is positive for the fight on inflation to see that commodity prices have come down off their highs and continue to weaken here. Fixed income pretty much winning everywhere except for BBB CMBS. This is through the end of the month, April 28th. The AG was up 360. The top performers were some of the riskier parts of the credit market. High yield up 460, CCC loans up more than BB loans. And Treasuries agencies up kind of 360 for the Treasuries. So risky credit up until the end of the month was winning. Obviously seeing a little bit of widening in very recent days with some of the vol in the marketplace. Since this has been printed here through April 28th, we're up another 40 basis points or so as rates have continued to fall. Pretty amazing. The Fed hikes rates and the 2-year falls in yield. As the market basically is telling Jay that he probably shouldn't have hiked, and there's problems out there in the banking system that persist, even though yesterday he told us that the banking system's fine. Here we have yet another one biting the dust today. Once you get down to these low dollar prices on these banks, nobody wants to buy the stock, nobody wants to buy their bonds, and it's just hopeless for raising capital. So that's something to keep on our radar. The 2-year note and the 10-year Treasury yield are at the bottom of the trading range. We definitely think that they have peaked for the cycle. They probably peaked, the 10-year peaked last October, and the 2-year peaked when it got to around 5% right before Silicon Valley Bank, which is that big drop in the 2-year. Both trading at the bottom of the trading range. The 10-year having a real hard time breaking down below this kind of low to mid threes level, this kind of 330 number. As I mentioned in the last episode of Channel 11, my advice to investors was don't get too cute on duration. If you get a backup, you're not playing for 20 basis points here. You're playing for, if rates fall below 330 down into kind of the 3%, 250 type area. So we did get all the way back to kind of 360 handle, hitting the 100-day moving average, which turned out to be a decent buying opportunity. Don't necessarily love this 330 level here on the 10-year right now, as it is the bottom of the trading range. So, but I do think in the long run, rates probably go lower towards the end of the year. So just something to keep in mind. If you want to be tactical about it, you wait for a little back up off this 330 level here on the 10-year. So the bond market is saying the Fed's done. This is expectations, and this is through the 2nd here a couple days ago. We're probably even lower than this today, but basically the bond market's saying the Fed's done hiking right now. And not only is it done hiking, we looked at this last month. The market also thinks that the Fed's going to cut. And the Fed's going to cut, by basically 100 basis points into January of next year, given views of a continued economic slowdown. So the Fed is telling us through the press conference yesterday, at least Powell said that unlikely that we're going to cut rates this year, but the bond market is expecting something to happen that's going to make us have to cut those short-term rates. What the Fed does have going for it, and the market has going for it, is that inflation expectations are anchored. This is a look at break-evens across the curve, 2, 5, 10, 30-year break-evens. You see that the blue line, which is the 2-year break-even, saw a little bit of a spike up when we got all that positive data in the beginning of the year in the first quarter, and that's come back down and settled down. So that is positive. That big spike up, and we mentioned it a couple months ago, was something that was a risk. Chris Flanagan from Bank of America pointed that out to us as something to watch, but that's settled back down. So that's positive for the market, as it expects inflation to be anchored. Another positive is that core goods inflation, which is the gray here, seems to have come down a decent amount. It's almost gone, right? So what's really driving inflation is shelter in the blue and services ex shelter in the yellow. The problem is that those two numbers could potentially be sticky, as we're seeing in some of the data. So on the shelter side, housing remains robust. Home prices actually just ticked up nationwide, despite all the haters' views last year of a collapse of GFC magnitude coming, which we've talked about a lot would not happen. We thought that we'd see about maybe a 5 to 10% decline in home prices was our base case at DoubleLine. We said about 10% last year. We're down 5 from the peak. Some places are down more. But what's happening is buyers are priced out of the purchase market because mortgage rates are so high, and so they're renting. So rental demand remains pretty robust, and that shelter number may be sticky there. And that's a decent amount of the inflation that we see out there. And the other part is services. While manufacturing is down, core goods is down on the inflation side, we see that job openings are still pretty strong. Wages are still rising, right? So here's wages. Wage growth is off the highs, but remains elevated. In the red, we've got average hourly earnings. And in the blue, we've got Atlanta Fed wage growth tracker, both off their highs, but still at elevated levels. The average hourly earnings still 5+%, right? So that's still pretty strong wage growth that's out there, which can push through that services inflation. Here are job openings. They're off their highs. This is a positive for the inflation fight, but there's still this big gap of openings relative to people looking for jobs. This is going to potentially continue that pressure of having wage growth remain high. And lastly, here we've got prices paid that jumped. This number can be noisy. This is also not helping the inflation cause. This is kind of why I think the Fed went 25. While there's some data that shows that things are coming down, looking at commodities coming down, core goods inflation coming down, you've still got services, shelter elevated, and here you see prices paid jumping is obviously kind of going the wrong direction here. So this is noisy. We'll have to wait and watch this with this number. As you can see, going back in time, it's noisy, but yet just one of the other data points we're looking at. And so we looked at markets. We talked about a little bit about inflation. Let's talk about the R word, recession. We've been looking at LEI almost every month, and it's an important forward-looking indicator, I think, because it's not backwards looking. It looks at a bunch of different economic data points, and it's been pretty negative, and it typically leads inflation. And when it gets this negative, we typically have gone into, it leads recession, which is in the pink lines. So I think You got to respect this. You got to acknowledge that there are pockets of the economy that are weakening, as they should, given the tight monetary policy, the removal of fiscal stimulus that we saw coming out of the kind of pandemic. So other signs of weakening: manufacturing PMIs sub 50 in the blue here, but services PMI, after having dropped down below 50, popped back up. Down again here, but still north of 50 at 51.2, still expansionary. So people are still out there spending on restaurants and other types of services, and that part of the economy is humming along. So it's this kind of mixed story right now of, housing having kind of seen a recession last year, manufacturing coming down, but services continuing to be relatively strong here in the near term. Here's Powell's favorite inversion, the 3-month 10-year. This is even more inverted probably now, but you can see that it's pretty inverted. And this, almost every single time that we've had a recession, does invert. And this is data going back to 1975. So you look at LEI, you look at PMI manufacturing, you look at this inversion, and these are signs that growth, we think, is going to slow, which is why we've been constructive on long-term treasuries, and why we think that you should be a little bit cautious when it comes to adding risk in your portfolios, both risky credit and also equity risk, which arguably looks really expensive given it's gone up so much this year. The savings rate skyrocketed when we got all the stimulus checks, and then it collapsed as inflation hit and people had to spend more money. This is not the best indicator for recession, but just theoretically, when you see this spike up in savings, you got to wonder, is the consumer saving because they're concerned about the future? And if they're saving, they're obviously not spending as much. So this could lead to a slowdown in retail sales, a slowdown in the spending on the services side. Or is the savings rate up because wages are up and they're making more money, so they have more money to put away, while gasoline prices, for example, have come down, food prices have come down a little bit. So just something interesting to note. I read an economist who, that was his thesis, is that after the savings rate drops and goes back up again, it's because people are worried about the oncoming slowdown in the economy or recession, job losses, and so the savings rate actually spikes. And you can see that kind of happened and worked a couple times, but it's not perfect. It didn't happen every single time we went into a recession. Now, the problem that the Fed has is they keep talking about needing the labor market to slow, and they need the jobs numbers to get worse. They need job openings to come down because there's no slack in the labor market, and that's why wages keep rising. The problem is that it's like the last thing to go. So by the time the jobs are gone, the recession is here. So this shows you, and this is from a guest we've had on, Gerard Manac, and you can see the red is the last Fed hike. The green circle is the first Fed cut. They almost happen pretty close together, and it's because the hike causes problems and economic slowdown, and so they have to cut. And you can see that the unemployment spikes kind of right after the cut. And so it's one of those backwards looking pieces of data where if they need to be more forward looking. If they wait for the unemployment rate to go up, it's too late. We're already in the recession. So I think this is the challenge that is going to face the market. Is the Fed and Powell going to be more forward looking and look at things like LEI and look at other data points, or just stay so focused on both that inflation number, which is also backwards looking, and some of the jobs numbers. Well, let's talk about the banks now. Started with SVB, Signature Bank, First Republic. We talked about it on the last episode of Channel 11, and I had turned more bearish. And I turned more bearish because there was a view I had, and the market, a lot of market participants agree with it now, is that the headlines from SVB brought to the forefront of mom and pop around the U.S. that these regional banks could be a problem, especially if you have more money there than the FDIC limit. But B, there's so much yield to be had away from your checking and savings account that are barely paying you anything. And as a result of this, you saw a lot of money flee deposits go into money markets, and My view was that if more money left the regional banking system, they're a huge lender to small business. Small business is something like 46% of employment in the US, and this would cause kind of us to go off the cliff of growth into the recession that the Fed kind of wants. And so here you can see that bank lending standards have definitely tightened. They were already tightening, I think, and you can see this relative to inflation. You saw this big loosening in bank lending standards in 2020, and so on the trail of that, you saw inflation pick up as money was circulating in the system. Just M2 got magnified, and so one way to think about it is maybe the tightening of lending standards may slow the economy and slow that inflation, maybe. Now, if you go back through history, and this is from Deutsche Bank a couple days ago, Jim Reed at Deutsche, history is not so sure that a tightening of lending standards is going to really bring that inflation down. So on the top is the U.S. It's got core PCE in the blue, and it's got the survey from the loan officers that we're waiting for that's going to come out next week. And you can see that this is going back through 1990. There's plenty of times when lending standards tightened and inflation didn't really go down. In fact, if you look at the early 2000s, lending standards tightened and inflation went up. Now, this was a period where inflation was already low, kind of at long run levels of, call it 1 to 2%. And so maybe that's why it's not so sensitive to a tightening in lending standards. But perhaps since we're so elevated on core PCE, that maybe this is going to help. So we'll just have to wait and see. But I thought it was two contrasting views. I've seen the argument from some market participants about this tighter lending standards, that's going to bring inflation down. And then Deutsche Bank put this out saying, maybe not, don't be so sure. On the bottom, euro area, again, same thing. Look at that big collapse in lending conditions in global financial crisis, and inflation just stayed there at 2 the whole time. So again, we'll have to wait and see how this plays out, but I just wanted to show everyone those competing views. I thought that was interesting. We looked at this last month. This is the flight of money at the deposits in the red coming down. You see the money markets going up, and then it kind of stopped going up. And that it was curious to me because I was pretty sure, I'm like, why would anybody leave their money at one of these regional banks? First of all, just move it to Chase, move it to Wells Fargo. Don't even worry about what's going to happen to these banks. Why even bother? It's not like they're paying you that much more than Chase is. And then alternatively, why even put it at Chase? Why not just go buy 6-month T-bills that yield 5? And it slowed down. I think it slowed down because generally people are lazy, and they don't, if they're below the FDIC limit, maybe they're not worried about moving it to, another bank. Maybe a lot of people aren't like us and just following the financial markets, but then the more and more they open their newspaper, they open their Instagram, they open their Twitter, and they see all this headlines of, another bank goes under, another bank goes under, another bank goes under. I think that it's only going to intensify this concern and pressure, and you may see more deposit flight. So we got to watch this. This is an important chart. We want to watch the flows out of banks into money market funds, into T-bills and things like that. Here's another view of it. This is a percentage change of U.S. bank deposits. Look at that dramatic increase. That's basically the stimulus checks came in. Everybody plopped them in the bank. The banks went out and impaled themselves on Fannie 2s, 2.5s, and Treasuries at 50 basis points, 10-year Treasuries at 50 basis points. And then we've seen this big reversal as short-term rates have gone up. The Fed is giving everyone this gift of sky-high T-bill rates that we haven't seen since 2007, right? Again, so this is something to watch. And if this keeps getting worse, that's not good for the banking system. That's not good for lending. And lastly, something else we looked at was the discount window borrowing. We noted that it spiked but had come down. So you see that things did calm down through kind of early to mid-April, and then it's starting to pick back up again. So if this keeps going up, this is also a negative. This shows that there's stress in the banking system as banks are losing deposits and in turn coming and pledging assets that they otherwise may be financing with the Federal Home Loan Bank, which doesn't give them a 100% advance. They can take those assets, come to the BTFP facility, get a 100% advance rate. So something that's on our radar and we continue to monitor. Well, what happened in April? Spreads definitely came down a little bit. If we looked at this last month, AAA CMBS was about 98th percentile. Agency MBS spreads actually widened because of some of the FDIC sales of the SVB assets. BlackRock for the FDIC is starting to sell assets, so spreads on agency mortgages have actually been widening in anticipation of that. We do think that the sales so far have been pretty good. They're getting decent execution. It's getting digested by the marketplace. Both the non-agency bonds are selling and the agency bonds are selling. Today is the first list of collateralized mortgage obligations from SVB that are in the marketplace, and we'll see how that trades. But so far, it's been digested. BlackRock is doing a good job. They're not trying to fire sell these assets. They don't want to widen the market on themselves, so they're slowly selling methodically in order to, sell through the list, but also maintain kind of the market levels that are out there today. But agency MBS surely looks pretty cheap still, as does CMBS. IG and high yield have both rallied through April 28th. They've widened a little bit here with the volatility. And so they look on the richer end. And as we've noted, bank loans looking cheap relative to high yield, but for a reason, we believe, with a lot of the risk having moved from the high yield market into the bank loan market. High yield was effectively shut down last year with limited issuance, and then the insatiable demand for floating rate assets led the CLO market to be open and the bank loan market to be open. So a lot of companies refied into the bank loan market. So the quality of the high yield index looks much better than the quality of the bank loan index, looking at the metrics based on rating. Now, I know bank loans are secure by assets, but the cost of funding has also jumped with SOFR up a lot, being floating rate assets too. So on the low risk end of the spectrum, I think that agency, MBS, and CMBS are two of the cheaper assets. And then on the riskier part of the market, you can go into places like bank loans, CMBS, and CLOs. They have risk. They will be volatile. But if you do your credit work, I think you still can find opportunities, especially relative to equities. I think that you could do better in some of these riskier credit markets than equities. Here is mortgage current coupon spread, just to show everyone kind of how wide it got. October of last year was the highs. This is for the bond that's trading close to par. We got all the way up to almost 180 spread to Treasuries. And you can see that we got a couple days ago, maybe a week ago, we got all the way back up to kind of low 170s, not quite to that 180 level, but we're still on the wider end here. So I think that in order for spreads to tighten, a couple things need to happen. We need to get through some of these FDIC sales through BlackRock and see how that gets digested. If the market starts viewing that we're not going to see a kind of big blowout in spreads and there's demand, and rate vol comes down with the Fed maybe being towards the end of the cycle, that could be the catalyst through the end of this year to bring these spreads back to normality. There's another argument that's out there that maybe we're in a world of consistently higher inflation, consistently higher interest rate volatility, and so maybe mortgage spreads should just be wider than they used to be. I think if you go back 20 years, the average spread on current coupon MBS is probably in like the mid 120s, 125 to 130. And so we're definitely wider than the last 20 years. I think over the last 20 years, we're probably, goes through the GFC, something like 85th percentile, 82nd to 85th percentile. Over the last 10 years, we're about 99th percentile right now. So even if you go back 20 years, it's still looking pretty cheap. And so that's kind of the thoughts on fixed income. Lower end of the trading range on the 2-year and the 10-year. So if you want to be tactical, not a great trading location. At the same time, in the long run, we do think those long-term rates probably fall. And so you don't want to get too cute and wait for, we don't think you're going to see 4% again. Stocks have done surprisingly well. The market is pretty optimistic about earnings. So this shows you the market's expectations of year-over-year earnings per share change, and the market thinks that we're going to basically see the lows in the third quarter, and then we're going to recover. And I don't know, it just seems that with the Fed hiking and GDP slowing, and if you look at the GDP data, January was pretty strong because it was a pretty warm month, and then the data starts kind of deteriorating into February and March. So this is one of the things that could be a catalyst for stocks to roll over, is this is too optimistic of a forecast. The other thing to think about is the good old sell in May, go away. This is the last 15 years. The average drawdown of May and June has been negative 463, and there was only 1 year without a drawdown in those 2 months, which was 2009. Pretty interesting. I mean, some of these years wasn't down too much. It was 18 down 70 basis points, but generally speaking, the trend has been down. But maybe it's not sell in May. Maybe it's sell in June. Here's another chart from Twitter that Jason Forright from our team found that shows you that May, actually over the last 10 years, has been slightly positive. It's really June that's the kind of the weaker month, even though it's been even positive. But the last 10 years have ripped for equities. So a couple data points on the negative side, couple data points on the positive side. And here's another one on the positive side, depending how you look at it, is that you got a lot of shorts out there. Speculators net position short. And so when there's this much short interest, sometimes, you know, the contrarian trade is that stocks go higher. And so I just want to throw out some of the potential positive views on equities, not just being a equity hater, being a bond investor. Finishing on the CAPE ratios, the relative CAPE ratios. If you're in any of the CAPE products, this is where the strategy focuses on the 4 cheapest parts of the market based on the relative CAPE. So looking at the CAPE ratio relative to each sector's own history. Just like in that fixed income slide, we look at each fixed income sector relative to its own history. And then it throws out the sector with the worst momentum, which is kind of that value trap. Cheap getting cheaper. And so in the US today, focused on tech, discretionary, financials, unfortunately, and real estate. Tech is working, however. And comm services is what gets thrown out. As you can see, it's had that bad momentum at the bottom. And then in the US, you can see that it owns discretionary, healthcare, communication services, and staples, throwing out materials in Europe. Well, that's it for the month of April. Hope you guys enjoyed some of our thoughts, view on what happened last month in markets, looking at some economic slides. Respect the data. The data continues to weaken. The Fed hiked again. The banks probably won't be lending as much. And we think that long-term bonds can do okay in that environment of slowing growth. So make sure, I know the T-bill is really cheap and everyone loves it. I own some, you own some, we all own some. T-bills and chill, but I think it's time to buy some. Make sure you have some of that longer duration exposure to protect your portfolio into more volatility out there. Good luck out there, and see you next month.